Good morning, ladies and gentlemen. My name is Stephen Fletcher. I'm Head of Retail Distribution at GSFM. And joining me from Epoch Investment Partners in New York City is Portfolio Manager of the Epoch Global Equity Shareholder Yield Fund, John Tobin. Welcome, John.
Hi, Steve. How are you?
Well, thank you. John, you've been with Epoch since 2012 as a portfolio manager of the Global Equity Shareholder Yield portfolio, a strategy that was designed by Epoch's founder, Bill Priest, back in 2005. The investment strategy's number one objective is to deliver income, and it has been very efficient in doing that. The Epoch Fund was launched in Australia a little over 12 years ago, back in May 2008, and has delivered more than 6.5% income per annum over the past 10 years, which has been fantastic. However, we come to 2020 and the world has hit a very large speed hump in the form of a pandemic. And as a result of COVID, we've seen many companies cut or cancel their dividends. Now, obviously, this is problematic, especially for our retirees, but Australian investors as a whole. So with your background, John, as a portfolio manager and also a senior equity research analyst, and also in a prior life as a senior credit analyst working in high yield, I'm very much looking forward to your view of markets, and in particular, your expectations around dividends from global equities for the remainder of this year and beyond. So what I've set out, I've put together roughly 4 questions for you as a way of providing an update to our clients. And John, why don't we start with the macro environment? I think it's widely accepted that the COVID-19 health crisis has pushed the global economy into recession. Can you provide a brief summary of how you've assessed the unconventional monetary policy response from global central banks and the fiscal policy response from governments? Do you think equity markets are correct in pricing in a V-shaped recovery? Or in other words, do you agree with markets that the policy response has been sufficient to support a swift rebound in economic activity?
So excellent question, Steve, and one we're spending a lot of time thinking about. And I guess I'd start off by saying that the COVID-19 pandemic has clearly caused a global recession. I don't think anyone's going to debate that point at this point in time. And the key questions that we're all wrestling with is how deep is this recession going to be and how long is it going to last? Now, in terms of the monetary and fiscal policy responses, I would say that both monetary and fiscal policy around the world has been impressive, both in scale and in speed. I think central banks have quickly turned to the playbooks that were written in the global financial crisis. We've seen target rates quickly lowered to the zero bound, and we've seen massive QE programs being launched. And fiscal policy has also contributed materially. I think I'd also emphasize that I think that the need for fiscal support programs remains critical and ongoing. Now, I would not go so far, we would not go so far as to say, or to make an argument that we can now comfortably assume a V-shaped recovery. Instead, the base case assumption that we think makes sense is that the global economy recovers gradually and unevenly over time. The reemergence of infections in Beijing, the upward trend that we're seeing in infections in the United States, in places like Texas and Arizona and Florida, and indeed what you're seeing right now in Melbourne, it reminds us that COVID did not go away, and millions of jobs were lost in the United States and around the world, and an unknown number are likely to be lost permanently. Some businesses, we think, will recover relatively quickly. Maybe manufacturing and construction will be the kinds of businesses that come back pretty quickly, but others are going to face a very long and uncertain future. Restaurants, theaters, hotels, airlines. Life is going to be very difficult for those businesses for a long time. And the question you pose, do we agree with markets? Well, it's an interesting question. And maybe the best way, I suppose, to answer that is just to say that short-term moves in the market can at any time seem overly optimistic or pessimistic. And maybe the market got ahead of itself with the rally in May and into early June, but maybe the market was overly pessimistic with the drawdown back in March. We honestly can't say. But we can assess the current environment and outlook as challenging and we can try to invest accordingly. And for us, that means investing in companies with favorable cash flow characteristics and capital allocation practices.
Okay, so carrying on from this, what guide does history provide as to the effect of recessions on the declining corporate earnings per share, dividends per share, and buybacks? I mean, does history reveal noticeable differences in outcomes between sectors?
Yep. So, in fact, some of the work that we've done on this question was presented in our recent webinar, and we titled that "The Death of Dividends Greatly Exaggerated." The historical evidence is actually pretty clear. In recessions, dividends tend to go down less than earnings in aggregate. And share buybacks act as a shock absorber, if you will. In addition, the evidence is also pretty clear that earnings compression and dividend declines in recessions, they tend to be concentrated in a few sectors, specifically financials, consumer discretionary, and energy. Those are the usual suspects, if you will. So right now, clearly there are headwinds. And I would say it's our task as portfolio managers and analysts managing this strategy. It's our task to identify companies that can withstand these headwinds. And we can see in our portfolio today, many companies are able to maintain their dividends. Indeed, many companies that we own have raised their dividends this year. Clearly, we have our work cut out for us, but we are managing our way through this difficult episode. And one thing that we feel very strongly about is that companies are not going to abandon sound capital allocation practices and policies as a result of the COVID pandemic.
Okay, so looking now more closely at the portfolio, how have you navigated these volatile markets? Because I'm sure there have been portfolio businesses affected in ways that materially changed your investment thesis. And at the same time, I'm sure the market has presented some great opportunities to add businesses to the portfolio. So what action have you taken within the portfolio? And could you perhaps provide a couple of stock examples?
Sure. So Steve, the first thing we've done in these volatile markets is to rigorously assess each portfolio position to measure its cash flow and dividend sustainability. And we've exited a few names in the portfolio where we determined that the business impact from COVID was very material. And this clouded the outlook for dividend sustainability. So some of the companies that we've sold from the portfolio, names like Cinemark, one of the largest theater operators in the United States, Darden Restaurants, which operates restaurant businesses, Simon Property Group, which is a big mall operator in North America, and Royal Dutch Shell, a few of the names that we've exited. In each case, out of concern for the company's ability to maintain its cash flow and sustain its dividend practices. But it's important to note that even as we've identified names to exit, we've also been very successful identifying companies that in the current environment, we feel will be able to sustain their cash flows and their dividends and maintain good dividend sustainability. So we've added some stocks. We've added Novo Nordisk, which is a Denmark-based pharmaceutical company with a dominant franchise in diabetes care. We added American Tower, which actually, despite the name, operates globally and owns cell towers. Danone, the consumer or the food products company, packaged food products company, telecommunications company like Orange, manufacturer of industrial equipment like Atlas Copco, JP Morgan. So these are some of the names we've added recently, and we feel comfortable that these companies will be able to maintain their cash flows and their dividends in this environment that we're operating in today. I guess I would just say that the portfolio remains well diversified. It is comprised of high quality companies. We feel confident that we can continue to deliver our portfolio objectives, and they are to deliver an average cash dividend yield between 4 and 4.5%, below market volatility, good upside participation, and strong downside protection. And honestly, that dividend yield is particularly valuable in what seems to us to be a world of very low interest rates for a very long time.
Okay, so let's get to the crux of this Q&A, and what I'm really keen to hear about is, what is your view on the outlook for dividends and share buybacks? Do you see any key tailwinds that are supportive of dividend sustainability and growth? And how are you positioning the portfolio to manage this outlook? Which sectors and businesses are best placed?
Right. So, well, as noted earlier, we do firmly believe that companies will, for the most part, continue to follow sound capital allocation practices. And to us, that means investing cash flow when a return can be earned above the cost of capital, and otherwise returning excess cash flow to shareholders through dividends, share buybacks, and debt reduction, shareholder yield. We recognize that there are significant headwinds facing the global economy and that many businesses will be forced to reduce or cancel dividends and or cancel their share repurchase programs. We're seeing that already. But we also believe, and it's important to understand, that not all companies are facing the same headwinds. So as noted earlier, pressures during recessions tend to be concentrated in a few sectors. And even within challenged sectors, history tells us that there will be stronger players who can maintain their dividends even during difficult episodes. And as for the share buyback part of the equation, our historical analysis tells us these act as a shock absorber, so they go up and down according to the environment. The immediate future may be one with generally lower share repurchase activity, at least in sectors that are experiencing pronounced earnings pressure. But if companies continue to follow sound capital allocation practices, we believe we will see the share repurchases recover as cash flows recover. One of the arguments that we've made over time, and I think continues to be relevant and relevant to your question in particular about a tailwind for dividends in this environment, structurally, we continue to argue that technology is allowing companies to adopt capital-light business models, investing less in brick and mortar and more in efficiency-enhancing technology. This frees up cash flow, and it makes it available for shareholder distributions. If anything, this trend may have been accelerated by the COVID-19 pandemic. Now, in terms of portfolio positioning, as you know, we don't have a top-down approach with the shareholder yield strategy. So we are not specifically dialing up or dialing down our sector exposures. Our process remains bottom-up, focused on the characteristics and the outlook for individual companies rather than a top-down approach reflecting sector biases. And that said, we seek to maintain good portfolio diversification across sectors and regions globally. We are remaining vigilant in assessing company cash flow and dividend sustainability, and we expect to continue to make incremental changes over time, consistent with the strategy's historically low turnover rate as we continuously monitor the current portfolio holdings and as we evaluate portfolio candidates that are suggested by our weekly screening process. The companies that are best placed to weather this period are those that have sustainable and resilient cash flow characteristics with management teams that remain committed to proper capital allocation. And we believe that these companies can be found in virtually every industry sector and geographic region.
Okay, John. So maybe as a way of wrapping up the Q&A, I mean, would you like to make any final comments in the context of our discussion today?
Sure. So I guess, to conclude, maybe I would just offer the following. This is a challenging episode, absolutely, but it's not the zombie apocalypse. As noted in some of my earlier comments, one, I think I'd emphasize, many companies have businesses that are resilient with capable management teams, and the management teams are responding to this environment decisively and effectively in a way to protect cash flow. They're reducing expenses. They're delaying capital spending projects. They're focusing on extracting as much cash as possible from working capital. We're seeing that in action. Also, I would point out that some companies in some industries and regions absolutely are facing acute pressure on dividends. I could point to the Australian banks as an example that you'll all be familiar with. That's why we believe our strategy, which is based on holding a diversified portfolio of global equities, is well suited to this challenge. Looking across global regions and industries, we are able to find high quality companies who are able to maintain their dividends through this period. And as noted earlier, we have seen quite a few raise their dividends this year. Also, I would say that we believe the companies will not abandon good capital allocation practices as a result of the pandemic. They will invest where they can earn an appropriate return and otherwise return excess cash flow to shareholders. The death of dividends, to echo what we said in our webinar, has been greatly exaggerated. And finally, I think the last point is maybe one of the most important ones, that in a world that is facing low or zero interest rates for the foreseeable future, the search for yield will continue. And we believe that the best place for investors to find income is in a diversified portfolio of high quality companies generating free cash flow that sustains attractive and growing shareholder distributions, specifically dividends. And we feel confident that we can continue to deliver our portfolio objectives: an average cash dividend yield between 4 and 4.5%, below market volatility, good upside participation, and strong downside protection. We think the strategy still works and makes sense for investors in the current market environment.
Well, terrific. Thank you very much, John. I think just a final comment. I think, since March in the financial press, we've all read a lot about potential issues for company dividends, and possibly there is the misconception that as a result of COVID, dividends will be slashed across the board. I mean, pleasingly, your comments today highlight that this in fact is not the case, and that investors, with the help of a professional investor such as Epoch, can still find companies across the globe that have the cash flows and the capital allocation policies to support and even increase dividends. John, thank you again. Ladies and gentlemen, thank you for listening. We hope this Q&A was of value to you, and we would welcome any feedback. Thank you for your ongoing support of Epoch and GSFM, and we look forward to providing another update for you all soon. Thank you again.